Hello students, welcome to the Recitals in-depth by Vajiram Ravi. Here we will be covering the economy and infrastructure April 2024 current affairs topics in great detail. And here we will be covering some broader themes. The main themes are Indian agriculture, money and banking, public finance, investment and infrastructure, and finally human and social development. Now recently the RBI has allowed the foreign investors abroad to invest in India's sovereign green bonds. Now sovereign green bonds are very important, and these will be the main aspects of delivering the climate finance obligations for the future generations. Why am I telling this? Firstly, to understand this, we have to understand the very simple aspects of how bond works. How simple bond works. Then we'll be understanding how sovereign green bond works. See, a bond is simply taken by a particular say investor when, say for example, that particular bond issuing authority, bond issuing person, that can be a company, that can be a government, needs more fund. So what happens? There will be various investors who will be having lots of sums of money with them. Then for example, there is another entity such as the government, such as the corporate entities, who will be needing funds, right? So this investor is having funds and they are needing funds. So what happens? This is a kind of a loan that these investors is actually giving to the government or the private sectors, right? Now, the issuer, right here, the government, the private sector, use this particular sum of money supplied by the investor to expand its operations, to do many other projects. For example, if it is the government, it will be spending, for example, more money on goods, public goods such as building better roads, schools, colleges and so on. If it is a particular private company, it will be using the bond money to expand its branches, business operations and so on. So the issuer will be using the particular instrument for expanding their operations, and the investor have given money to the issuing authority. So they will be given some periodic money such as interest rates, or say through coupon rates. Coupon rates, for example, say mean, for example, if a particular bond is issued at 100 rupees, this 100 rupees is known as face value of the bond. Now the investors, they will be buying this 100 rupees bond at a discount of 10 rupees. So this 10 rupees is actually known as the coupon rate or the discount rate. So after, say for example, 1 year, the investor can take this 90 rupees bond, right, with face value of 100 rupees and get the full value of 100 rupees back along with his 90 rupees. And obviously the issuer pays the investor's principal at the end of the term, right? So here the same concept is there in sovereign green bonds. Sovereign green bonds is actually a conventional bond, that the thing that we have just discussed, where there is an investor, where there is government or corporate sector, where the investor is giving cash and the government is giving a commitment to repay this cash, say this principal amount, along with coupon rate after a period of time. So a green bond is a combination of conventional bond plus a green certificate. Now what is this? See, the government will be taking money via conventional bond. Now these conventional bonds will be investing in government schools, colleges, roads, airports and so on. But governments can also invest in green businesses or in green projects such as setting up solar panels, building dams and various other green projects, right? So if that money that the government is investing is actually in green projects, then the government will be also giving a green certificate, where the government will be funding finally a green project with a green commitment by the government, which is an assurance that I will be using the public money to only fund the green projects of the country. So this particular bond is actually known as a green bond, where it is a government assurance, government commitment to actually take the investors' money and invest in green projects. Now here, there are many projects which are decided by the government, which will be actually green projects. And also if we look at the evolution of the green bonds across the world, the very first ever green bond was to be issued was by the European Investment Bank. That was in 2007. Now this information is very important for your prelims, right? Now the second a major event came in 2014 when first certified climate bond was released by a private company in the United Kingdom. Then the green bond markets hit $1 billion, and this was just after 1 year in 2015. So a lot of investors are right now interested in investing in green bonds. So that is a very, very positive thing that is happening right now. Next, in 2016, the first sovereign green bond was issued by Poland. Now, one difference has to be made here. The earliest green bond here was actually issued by the private sector, or say by various other organizations, international organizations, but they were actually not countries. The first country, a national country, right, a sovereign country, was actually Poland, who issued the sovereign green bond. Right? Later, France also came into the same, along with Fiji, Nigeria, and so on in 2017. In 2018, Indonesia also comes to this green bond market, followed by Belgium, Lithuania, and so on. So alongside this, we see that all of the nations gradually is actually issuing more and more green bonds. And here we have to understand the main projects in the nation where we actually can invest our green bonds in. So if you see here, these are the various eligible projects where the government has actually permitted to invest in the green bonds. For example, renewable energy, clean transportation, sustainable water and waste management, pollution prevention and control, green buildings, natural resource conservation, terrestrial and aquatic biodiversity conservations, energy efficiency, including construction of low carbon buildings and so on, and climate change adaptation projects to make infrastructure more resilient, such as building dams, building coastal safeguards against cyclones and so on. If you look at the very commonalities across all these projects, these are green projects which is actually sustainable in nature, and this will be helping India realize its Panchamrit mission of achieving India or actually propelling India to becoming net zero by 2070. And there are some projects which are not included in this green sovereign green bond projects also. The projects such as involving new existing or production of fossil fuel. Obviously, fossil fuel component will not be there in the green bond scheme. Then the nuclear power generation, direct waste incineration, alcohol, weapons, tobacco, gaming, palm industries and so on. Renewable energy projects from biomass will also be not there, because biomass is also associated with emitting a lot of carbon dioxide. And finally, landfill projects, hydropower plants which are larger than 25 megawatts, which are actually big projects, these are also not included. So who takes the final call actually in declaring all these projects? It is finally the government of India through the involvement of various ministries. The ministries of environment and climate change, the Ministry of Housing Affairs, Agriculture, Farmers Welfare, New Renewable Energy, and also various other ministries. They will be submitting a list of various projects which will be known as the initial list. Now, these lists will be sent to a project evaluation and selection committee, which is also known as the Green Finance Working Committee. So this committee will be consisting of Chief Economic Advisor of the nation, very, very important fact of UPSC Prelims. Then there will be other various government bureaucrats itself, right? And there will be additional secretaries, infrastructure, finance secretary, member secretary will be there, Ministry of Environment will be there, Ministry of New and Renewable Energy will be there, climate specialist from Niti Aayog will be there, right? Then PDMC from Budget Division will be there, and any other ministry will be also co-opted from time to time. And finally, they will be deciding on the final list, and this will be the eligible green project list that we have seen right now. So these are the lists so far, right? They will be finally decided by this. And who will be releasing the bond here? The sovereign green bond. Obviously, the government of India will be releasing, but it is the PDMC, the budget division under Ministry of Finance, right, who will be releasing finally the green bonds, the sovereign green bonds. So they will be issuing green bonds, they will be managing them, and also be allocating whatever the money received from the bonds to the various green projects. So this is the overall architecture of the sovereign green bonds in our country. Now, recently, obviously, the RBI, I told you, has allowed investors, the foreign investors, to come and invest in India's green bonds, right? So obviously the main benefit is obviously increasing the pool of investors. Earlier the domestic investors could invest in the green bonds in the nation. Right now the foreign investors, and prominently the foreign portfolio investors, the foreign institutional investors, they can also buy the same. So it will be increasing the pool of money that will be available for the country for green projects. Next, it will be also enabling green financing in so many projects of the country. As we can see, right, as we can see in this particular map, right, with reference to energy, with reference to low carbon buildings, with reference to industry, waste pollution, transportation, information technology, agriculture and adaptation, we have so many opportunities. We have so many opportunities of investing the green bonds in. So we have to understand that these are the various projects where the investors, the foreign investors, they can come and invest in. So please do note, take a brief note of all these industries here. And here we can obviously find that green finance will be available to more and more investors as of now. Then it can also help India to transition to a low carbon footprint, where carbon footprint typically measures the amount of carbon dioxide emissions per capita, per industry, per individual and so on. So it will be also reducing the carbon footprint and helping India becoming a low carbon footprint economy in the near future. Finally, it is also realizing India's Panchamrit, which is the 5 main targets that India has to achieve by 2030 by 2070, and also selectively some targets by 2030 to help India becoming a green economy. Firstly, we have to achieve 500 gigawatts of non-fossil fuel energy by 2030, right? So non-fossil fuel energy sources such as the solar energy and wind energy and so on, they must be promoted, right? Next, 50% of the energy must be coming from the renewable energies. Next, we must be trying to reduce our carbon intensity of the GDP, or the amount of carbon dioxide to the GDP of the country, by around 1 billion tons, or say in percentage it will be around 45%. And finally, achieving net zero by 2070. And finally, it will be also helping India in realizing Panchamrit. Panchamrit means these 5 targets. Firstly, we have to achieve 500 gigawatts of non-fossil fuel energy capacity by 2030, where we see all kind of non-fossil fuel energy from the side itself. Next, we have to gain 50% energy from, say, renewable energy such as solar, wind energy and so on. We have to also reduce the carbon emissions by 1 billion tons by 2030 by more and more afforestation, and also reduce the carbon intensity of economy by 45% by 2030, and also achieving net zero of carbon emissions by 2070. So these are the various aims and ambitions with which the RBI is also allowed right now the foreign investors to invest in sovereign green bonds. Now, along the same lines, we have this practice MCQ again for all of you. Please do attempt this question and let me know in the comment section what is the correct answer here also. According to Asian Development Bank's recent reports, it has been seen that India has been seeing instances of imported inflation, or that type of inflation in which the domestic goods are becoming more expensive because of some instances which are happening internationally. So let us understand in this article what the exact thing is actually happening here. Now see, there has been cases of imported inflation according to Asian Development Bank's report. Now what this is the thing, that recently it has been seen that the US Fed or their own Reserve Bank of India or their own central bank, they are actually increasing the repo rates or interest rates. Now what is happening? If the interest rates in the USA is increasing, now the investors all around the world, they are going to the US because they want to invest in the US right now, because simply the interest rates in the US are actually much more higher. So even for example, say the interest rates in the US has increased to 5%. For example, say initially the interest rates were 4% in both US and India, right? Now what happened? Fed has increased the interest rate to 5%. So what the investors in India they will be doing, both the foreign investors and the domestic investors, now they see that their investment will be getting higher returns of 5% in the US. So they will be all selling their investments in India and taking all their money in India, money from India, and going to the US and investing in US. So this will be leading what? This will be leading to dumping, right? This will be leading to dumping of Indian rupee in the market, because obviously they will be selling everything in India and they will be going to the US to invest, and that is when the amount of rupees in the market they will be increasing. And when the supply of rupee has increased in the market, right, this means that right now more and more people, apart from demanding rupee, they are demanding more and more dollars. So whenever there is more demand of dollars and more supply of rupees, we understand this is the case of depreciation of Indian rupee. So this leads to rupee depreciation, and this rupee depreciation is due to the investors selling their assets in India and they are going abroad to the US to demand more dollars there, and whatever they're demanding more dollars, they are dumping the Indian rupees, increasing the supply of the Indian rupees, resulting in the depreciation of Indian rupees. Now this depreciation of the Indian rupees, this depreciation is having some impacts on the importers of the country. Now we know that whenever depreciation takes place, it means that imports have become more expensive, because earlier the rupee was not this much cheap, right? Right now you need more rupees to buy one more dollar. So that is what depreciation is, and that is where the importers will be losing out, or say the imports will be becoming more and more costly. And we understand in India we import crude oil, we import various other chemicals and various other raw materials from various other nations. So if import is becoming costly, if raw materials are becoming costly, then the final produce in the country, they will be also becoming costly. Now what was the cause of inflation? The cause of inflation was the increase in the Fed rate in the very beginning. So the increase in interest there led to depreciation of Indian rupee. This depreciation made our imports more costly. These imports were actually, say for example, of raw materials, crude oils, which are used in Indian production of various goods and services. And now those goods and services become more and more expensive. Their prices increased. So this is how imported inflation takes place, through the rise in federal interest rates simply, right? And generally the developing nations, countries like India and the other nations, developing nations, they majorly face this issue, because whenever the interest rates in the US they will be rising, people will be demanding more and more dollar, and they will be increasing, they will be actually supplying the domestic currency, for example rupee, in the market, leading to depreciation. So it is the developing nations, particularly India, which is also seeing this phenomena. And here depreciation will be leading to higher imports costs, but also the same phenomena can also take place without depreciation. Without depreciation, how is it possible? For example, there is some issue taking place in the Gulf region, right? For example, the UK, the Bahrain and the Red Sea corridor, right? Which is actually very rich sources for energy across the world, particularly the crude oil, right? So for example, there is some issue, there is some conflict that is taking place in the Gulf region, right? And for example, due to some reason, Saudi Arabia's Aramco, right, which is their own largest, even the world's largest crude oil supplier, one of the largest suppliers, right? For example, there is some attack, there have been some attacks on Aramco, right? Now obviously the supply of crude oil, they will be decreasing. the supply will be decreasing, and when supplies of a very, very important substance such as crude oil, they decrease, they will be definitely increase the price of the final crude oil, and this decrease in supply will be increasing the prices of the crude oil. And when the prices of the crude oil, they will be increasing, India also imports the same. India has to import the same at higher prices right now. And again, when India is importing crude oil, India is also importing higher priced crude oil, hence leading to imported inflation again. So not always it is the case that only with depreciation imported inflation will be happening. It is also sometimes without depreciation, when some commodities prices, they take a hit and they increase, right? And everything in imported inflation gives rise to something which is known as cost push inflation. Now see, cost push inflation is actually very simple to understand. This means that the prices of any goods and services are actually what? They include the cost of production, and also they include the profit of the particular producers and the companies also, because they produce a goods and services and they incur a cost. They have to recover the cost via the prices, and also they have to keep a profit. They keep the same through prices. And what can be the reasons when prices will be increasing? Because of the reasons of the increasing cost, or increase in profits of the various goods and services. Mainly it has been seen in inflation. In inflation, the prices are pushed due to costs of production, right? And here we can understand cost of production is increasing mainly because firstly, the import costs have increased due to depreciation, right? Because depreciation has taken place, the import cost has increased. And also cost push inflation is also taking place because some global commodity prices such as crude oil, right? The prices of which they have also increased. So this is the main aspect of cost push inflation which is happening in this particular context. Now for the same, I have again another question for you. I know there is a lot of questions and this will be also enhancing your concepts regarding the same. So please do attempt this question and mention the answer in the comments below. Pause the screen, look at the question and solve the same. Recently, SEBI has included some derivative contracts from the Nifty Next 50 index. Now first we will be looking at what are actually derivative contracts. See, a derivative is any stock, any bond, any commodities, any currency, interest rate or bonds or market indices even, right? This is a financial security which a value that is reliant or derived from the underlying asset or a group of asset. For example, take the case of this commodity. Maybe for example, this is a crude oil, right? Now this will be a derivative when this crude oil prices will be tagged to the market, say the commodities exchange market, similarly the stock markets itself, and people will be buying, say for example, shares. People will be buying shares of the crude oil. But we have to understand, while commodities such as crude oil are actually physical commodities, right? These are physical commodities, but these shares are trading in the markets based on the demand and supply of the crude oil in the markets. So the underlying asset of the share, or they say for example, this share is backed by a commodity such as crude oil. For example, this share can be even backed by any bond, any currency and so on. So any financial instrument, right? It can be any financial instrument. It can be share, it can be any other instrument, right? Which is actually traded in the markets, and that is actually known as derivative. Okay. Now here SEBI included further a few more derivatives in the Nifty Next 50 index. Now we have to understand what this Nifty Next 50 index is all about. See, when we talk about Nifty, Actually, this is a collection of various companies, Indian companies, right, which are actually listed on the stock markets. So these are actually, when we talk about Nifty 500, these are top 500 Indian companies with reference to their revenues performance in the stock market and also in their actual say portfolio too. So we have Nifty 500, and from Nifty 500 we have 3 more Nifties. These are the various indexes, right, where it is helping the investors to invest in these companies. So further, this Nifty 500 index has been divided into Nifty 100, Nifty mid cap 150 and Nifty small cap 250 companies. Now when we're talking about caps, we mean that this is about some valuation of the various Indian companies. Large cap Indian companies are those companies whose market value has reached more than 20,000 crores and above. These are stocks of well established company that stay consistent during economic cycles. Then mid-cap companies are the companies where the valuation is between 5,000 to 20,000 crore. Small cap companies are those companies whose valuations range up to 5,000 crores. So based on this, the Nifty's small caps and mid caps and main large cap companies, that is Nifty 100, they are also measured. So within this large cap Nifty 100, we have Nifty 50 and the Nifty next 50. And this is where this next 50 is actually coming from. As we can see here, as of now on, right, we have various companies, 50 companies from various sectors such as finance sector, capital goods, power, oil and gas, consumer services, FMGC, chemicals, auto, realty, metals and so on, right? So these are 50 companies where these are actually the part of Nifty large cap 100. And after subtracting the Nifty 50 from Nifty 100, we get Nifty next 50, right? So these are actually the various categorizations also that we can see here, right? Next, we can also see the various categorization of mid cap 150 of say Nifty mid cap 50 and mid cap 100. Then we have small cap 50 and small cap 100, right? And then if we combine the Nifty 50, Nifty next 50 and the Nifty mid cap 100, we get Nifty 200. So these are the various categories, but you don't have to remember all of this because these things are not that much of importance in UPSC prelims. But obviously if Nifty 50 is in the news, you have to know how Nifty 50 is composed of and what are the various caps and the market caps are. Now again, we have another practice MCQ for you to solve. Please do mention the answer of the same in the comments below. Recently, the term InvITs, Infrastructure Investment Trust, has been in the news, and this is because in India, a major prominent InvIT has just announced its plan to expand its business operations. And for our exam purpose, we have to focus on the various aspects of InvITs and the various concepts of the same. Now see, by InvIT, we have to understand this is a kind of an investment vehicle which is used by the government and also the private sector to raise funds for various infrastructural projects in the country. Now, InvITs is actually a trust which raises money from individuals, companies and institutions to actually invest in infrastructural projects in the country. And when we talk about the money that has been raised, this money is used in constructing roadways, highways and energy projects, farm projects, towers, connectivity, telecom operations and so on. So, and also the revenue that will be generated from these projects, then the revenue from this, for example, say the road, for example, the toll charges, say for example energy distribution profits and so on, those parts of the profits, they will be distributed to the people who have actually contributed money in the very first time, who are actually known as shareholders. So the shareholders, they will be getting money from the InvITs, right? And this is why they will be investing in the InvITs for the very first time. And here, when we talk about InvITs as a popular investment models, right, in the country, it has been seen over a period of time, right, as of 2019 data, the use of InvITs in various projects across the country, they have increased. For example, from 2017 onwards, if you can see, the country has been using InvITs to build various projects on say roadways and so on. Then we also have this IndiGrid project, which is actually the India Grid Trust, which is a kind of an InvITs for power distribution in the country. Then we have had various InvITs over a period of time. As we can see, going forward, right now, the India Infrastructure Trust and the various gas pipelines and the various roadway projects and the various other infrastructural projects and even the real estate projects, they are seeing a huge amount of interest of going through the route of InvITs. Now here, we have seen the basics of how InvITs operate. There are various projects, infrastructural projects. So these projects are given funds by the shareholders. When the projects will be completed, the shareholders will be also given a share of the profits after these projects have been completed. Now, we have to look into the structure, how this particular thing works. Now, when we talk about InvITs, there are many stakeholders here. Be it the real estate infrastructural trust, right, investment trust, or say the infrastructure investment trust, you know, their model is kind of same only, right? When we talk about this, we have various stakeholders. The stakeholders firstly are begin from the sponsors. So these are the sponsors, these are the people, people like you and me only, or the people who have high say access to funds, such as banks, such as wealthy individuals and so on. They are the sponsors of this investment, projects. Next, there will be some beneficiaries of these projects also, which are known as unit holders. Then there will be a trustee. A trustee is actually that entity in any InvIT who is actually tasked with the norms and rules and procedures that must be followed in the InvITs, right? That is particularly this trustee will be looking into the SEBI norms and registrations with reference to the fundings and finances of the investment project here. Then on the other hand, there will be another manager, REIT manager or InvIT manager, who will be actually looking into the asset management and looking into the acquisition of various new properties. And finally, there will also be a project manager. This will be responsible for the day-to-day management of the projects such as roads, highways and so on. So this is the major aspect of the REIT and the InvITs here. And here the main structure, as we have already seen here, is also summarized here. There are four important parties: sponsors, investment managers, project managers and the trustee. Sponsors are those promoters of the company who set up the InvITs, right? In case of PPP projects where the government is also in the InvITs, it refers to the infrastructural developer or the special purpose vehicle, which sometimes government also names as SPVs, which the government is actually setting up to oversee the management of the InvITs, right? Then the trustee is actually certified by SEBI, as I already told you. They have the responsibility to ensure that the functions and the various rules and regulations are in compliance with the SEBI norms, because ultimately SEBI is regulating the main regulator when it comes to the InvITs and the REITs in the country, right? Then also finally we have the two managers, the REIT manager and the project manager. They will be looking into various operational aspects of the same. And here, firstly, the main process starts with investors who buy units of the InvITs. Next, the InvIT projects will be investing the same funds from the investors in the project itself. Then the InvITs project will be receiving cash flow. For example, if it is a road that has been constructed, the road will be given toll charges. So this toll charges is a kind of a revenue or even a source of profit. So from this charges, the profits and the dividends will be distributed to the investors. And let me tell you, for any kind of dividend, or any kind of interest that investors get from the InvITs, they are always taxable. They are always taxable, right? So we have to understand that any kind of income that you get from the InvITs, they are actually taxable under the Government of India rules and regulations, particularly the taxation norms. And here we have a question from the PYQs from the 2023, particularly talking about InvIT and also their inclusion in the SARFAESI Act. Now I want to discuss this thing here. See, I just discussed that InvITs and even the REITs, whatever the income you are getting from it, with interest income, with dividend and so on, you have to pay a tax on the same. But if you look at this statement 1, this statement 1 is telling that in interest income is exempted from tax, but dividend is taxable. This is not correct. And also, InvITs are recognized as borrowers under SARFAESI Act. Now, SARFAESI Act is applicable to those defaulters, right, who have willfully defaulted, right? That means people like Nirav Modi, Vijay Mallya and so on, they have individually taken loans, right? And they are not individually paying back the loans back. So these are willful defaulters which are covered under SARFAESI Act. Now individual willful defaulters can be people or say individuals, can be companies, they can be InvITs, right? They can be anyone, anybody who has willfully defaulted. So that is why the statement 2 is actually correct. Recently, the Government of India via the Central Board of Direct Taxes signed the highest number of advance pricing agreements. And here, to understand this topic, it is very important that we understand the concept of transfer pricing first. So imagine that there is a company X, and this company X is a multinational company, or we also know that abbreviated as MNC. So this is an MNC, as you know, like many MNCs, like all of the MNCs in the country and also in the world, we have many subsidiaries of the same MNC. For example, this MNC can have a chemical subsidiary and also can have a pharmaceutical subsidiary also. So these two will be having separate registrations and separate entities and so whatsoever. But we have to understand these are under the same umbrella company of this company X. Now for example, imagine that this chemical industry is actually situated in Mauritius, right, where the tax is very low. The overall tax that this company needs to pay to Mauritius tax authorities is, for example, as low as 5%. Right? Now, for example, say this pharmaceutical company here, this is based in India, right? And they have, for example, in India, the average corporate tax is, for example, say at 20%. So if you see, right, the overall tax liabilities of this particular company in India will be higher because they have to pay 20% taxes, and the same in Mauritius will be a little lower because they have to pay only 5%. So you can understand, for a company, the main motive for them is to have highest number of profits. So the main profit making agency will be telling the MNC to reduce their tax burden. So can you tell me which of the following countries they will be more interested in actually basing their important operations? Obviously it will be Mauritius. Now here the transfer pricing thing will be actually coming into picture. See, transfer pricing actually means that whenever the same subsidiaries of the same company are actually selling some goods and services between themselves, they're actually having some prices obviously between themselves. For example, say in the pharmaceutical industry, we know that we require many types of chemicals, and it is a good thing for this company X that it is also having a pharmaceutical subsidiary, and for the same it is also having a chemical subsidiary. So what the company X will be telling the pharmaceutical company is to directly buy any kind of solvent, any kind of chemicals directly from the chemical subsidiary to the pharmaceutical subsidiary. So here what will be happening, for example, say since Mauritius is having a very low amount of taxes, the company will be telling the chemical subsidiary to sell this chemical for, say for example, 200 rupees, where maybe the market price, right, of this particular chemical is only 100 rupees. Now why are they doing this? Because I told you, right, since this is a low tax country or low tax jurisdiction, they would want to have more profits in this country, right, because their profits will be taxed less in Mauritius in this chemical industry. So obviously they will be pricing their product or say the solvent that they will be supplying to the pharmaceutical subsidiary at higher than the market prices to have more profits here, right? Because more profits in this particular country will be leading to less tax burden, right? And we can understand, if this particular company is selling this chemical at 200 rupees, that is above the market price, then it will be purchased by the pharmaceutical company at 200 rupees. So they have to pay higher than the market price. Obviously they will be having lesser amount of profits, right? They will be having lesser amount of profits, but less amount of profits is fine by this company because they have already earned some profits in this particular nation. And here in India, for example, they will be having lower profits, and on the lower profits they have to pay higher taxes, but that is fine because they have already paid lower taxes here on the higher profits here. So this is how the companies cleverly price their raw materials between across their subsidiaries of the same company to actually pay less taxes. And this is a very clever way of actually avoiding paying taxes. And here we have to understand the fair practice is actually to charge this subsidiaries the various raw materials and whatever the transaction that is taking place between the various subsidiaries is actually to charge this whatever raw materials at market prices, right? So we understand whatever the market price of the particular commodity should be, that should be the main charged aspect of this particular transaction. But that does not often take place because companies, they sometimes manipulate their tax decisions and also their profits by manipulating the raw material prices. So that is why we have to understand the government authorities, they will be always wanting that this whatever the raw material should be across various nations, across various companies, they should be charged at market prices, that is at fair prices. That is actually known as arm's length principle. That means the pricing of this particular chemical, they must be at arm's length along with the market price. That means whenever the government authorities are telling that these subsidiaries must be charging at arm's length, that means they are implying that it should be at market price. And it is also making sense because through this we can understand India is losing. For example, if India is having this pharmaceutical subsidiary, India is losing on tax revenues, right? So that is why we have to understand that India has an arrangement to overcome this particular provision. Right here we have this advanced pricing agreements. Now advanced pricing agreement is actually an agreement or say an arrangement to avoid transfer pricing, to avoid tax avoidance by the various companies. Now APA or advanced pricing agreements is an agreement between a taxpayer. A taxpayer can be a particular company, as we have seen in the case of company X. It can be company X and the tax authority of the concerned country. So the taxpayer and the tax authority, that is our own Central Board of Direct Taxes or the Indian tax authorities, they will be coming into an agreement for determining the transfer pricing methodology for pricing the taxpayers' international transaction for the future years. For example, so they were practicing the transfer pricing in 2020. Now, the company and the Indian tax authorities, they will be deciding, for example, say for the next 5 years, you cannot manipulate your transfer prices, right? So this will be the arrangement here. The main aim of this advanced pricing agreement is to provide clarity and predictability to the taxpayers regarding the transfer pricing by already outlining the methods for pricing. That means it should be at market prices, it should be at arm's length provision, and also for determining the arm's length price of the international transactions for advance up to 5 years. So for example, if this APA has been signed between two companies and say for example a tax authority, it should be, for example, say if it has been signed in 2020, it should be valid up to 2025. So between these 5 years, the companies, they cannot change any transfer pricing methodology and it has to be totally transparent with the government of the day, that is the tax authorities of the day. And taxpayers can also opt to apply the APA to the previous 4 years also. That means the companies, they can also tell that, okay, for the last 4 years, for example, say from 2016, I have kept this transfer pricing or say this prices of the various raw materials between my various subsidiaries, and it can say have a certainty of this particular tax provisions of this particular transfer pricing for around say 4 years plus 5 years, that is from 2016 to 2025. It can have a certainty of 9 years that this will be my transfer pricing, and the government authorities will be also saying that this will be my taxes. So for 9 years there will be a particular clarity for both the company and for both the government that they will be having a particular tax certainty and also the transfer pricing certainty, right? And here additionally, signing bilateral APAs can also protect the taxpayers from any double taxations. Now we have seen that this particular practice is actually leading to tax avoidance by the companies. But sometimes what happens is that sometimes the government also may impose double taxes or say excess amount of taxes. They can also raise the taxes. So if they lock in the APA agreement for 9 years, so at least the companies will be assured that they will be having to pay the same taxes for 9 years, and they can also keep their profits maximized. So this is the main aim and targets of the APA. And here we have to also look at the various types of advance pricing agreements. Now see, when we look at the types, we have to understand there are 3 types: unilateral, bilateral and multilateral advance pricing agreements. Now see, unilateral, the very term means that it will be existing between 2 parties. That is the taxpayer, that the private companies or say the MNCs, and the tax authorities. In our case, it is the Central Board of Direct Taxes, right? So this is involving only 2 entities, that is the company and the tax authority. Now, this should be the country where the taxpayer is actually located and doing their economic services. That is the pharmaceutical company in India, and also the, for example, the chemical industry in Maldives, right? Now here in the second type, that is a bilateral APA. This type of APA involves the taxpayer, that is the company, associated enterprise, that is their subsidiaries, right? And also the the tax authority of the country, that is in our case the Central Board of Direct Taxes, right? So here we have this bilateral where we have the concerned taxpayer, we have the associated enterprise of the various subsidiaries of the company, and also the tax authority. Finally, we have this multilateral APA. This involves the taxpayer, again 2 or more subsidiaries of the company, right, in various foreign countries. That is the case we have just discussed in our example with the company X example, right? So we have the taxpayer, we have various amount of subsidiaries, right, and also the tax authority of the company, right, or the tax authority of the country itself. So here, when we are talking about the tax authority, I have told you it is the Central Board of Direct Taxes in the country here. So it is the Central Board of Direct Taxes is a statutory body in the country and is functioning on the Central Board of Revenue Act of 1963, and that is why it is a statutory body. It is also part of the Department of Revenue in the Ministry of Finance. On one hand, the CBDT provides the essential inputs for policy and also planning for direct taxes in the country. So whatever the direct taxes and whatever the slabs and whatever the percentages and everything will be actually advised by the Central Board of Direct Taxes here. And also it should be also providing the various administration norms of the direct taxes in the nation too. And the CBDT is headed by the chairman and comprises of 6 members, all of whom are actually ex officio special secretary to the union government or the government of India. So actually this could be all of you down say 20-30 years in the line when you become future bureaucrats of the nation. So one day you will be also serving in the Central Board of Direct Taxes here. Now coming back to the news here. Now recently I told you the largest number of APAs has been signed. Now CBDT has entered into 125 APAs, advanced pricing agreements, with different companies with their own subsidiaries in various foreign nations. So this happened in this financial in the last financial year. According to the previous financial year, this has been a 31% increase. Now this data is not that much of importance for you, but this is just to show that Indian tax authorities are taking steps to curb the illegal or say unethical practice of the high amount of transfer pricing. Now here 86 UAPAs has been signed and 39 BAPAs has been signed. Okay, and most of them are from the entities of say the companies from Australia, Canada, Denmark, Japan, Singapore, United Kingdom and the United States. And here we have a total amount of 641 advance pricing agreement, and this is one important portion of your prelims, because they can ask that which of the following is actually more in comparison to the other. For example, in India, we have the higher number of advanced pricing agreements with reference to the unilateral route apart from the bilateral route. So this is one important fact for your prelims here. Now, I have one MCQ for you all to actually solve. This is a very good case study. The case study has been, the main aspect of the case has been shown here. And according to, you have to give me the correct answer in the comments. So please do mention the answer here. Recently, India saw a huge number of surge in its direct tax collections. And when we are talking about direct taxes, we mean those kind of taxes where there is one taxpayer, right? There is one taxpayer and there is a tax authority. That is the government of India in our case, right? So when the taxes, for example, based on the income, based on the various other aspects, are directly paid to the government of India, this particular aspect is known as direct taxes. Or say here, the burden of tax is falling directly on the taxpayer to pay the taxes directly to the government without any intermediary in between, right? For example, in the case of personal income taxes of the salaried people, of the self-employed people, they have to go to the income tax portal. And they have to log in with their various credentials such as PAN card and various username, password, and at the end of the financial year, after April, say, they have to file their income tax returns. And these income tax returns have to be directly filed with the government of India via this income tax portal. So this is one of the cases of the direct taxes where we are talking about personal income taxes. It can be the same with the corporate income taxes and the various other kind of direct taxes. So here, this is a tax which is levied directly on the taxpayers, and it is levied directly on the income of the individuals and any other entities without any intermediary. And direct taxes in India and also the overseas are actually seen by the Central Board of Direct Taxes, right? And here in India, we have various kinds of direct taxes in the nation. For example, we have the personal income taxes where the individuals themselves, after having their annual income, they pay a particular amount of direct taxes, right? In India, we have various slabs. Of direct taxes. For example, if you belong to around say 7 to 9 lakhs per annum, you have to pay a particular amount of taxes, and so on. In India, we have also the corporate income taxes, which is the kind of taxes where the companies, private companies, or partnerships or very other entities who are doing business entities in the country, they pay taxes to the government. We also have the capital gains taxes. Now, when we talk about capital gain taxes, we are talking about classes of assets, right? These are the assets. For example, say this can be land, this can be any kind of say painting, right? This can be your stocks, right? So there are many kind of assets where the people actually hold the assets, and after they actually hold the asset, they sell the assets for a particular amount of price in the future. So whatever will be the difference between the same, that is actually known as the capital gains taxes. In India, we have long-term capital gains taxes of 10% and short-term capital gains taxes, that is of 20%. But again, this is actually dependent on the various classes of assets. According to the various classes of assets, maybe the capital gains taxes will be also changing. Next, we have the security transaction taxes and the commodities transaction taxes. Now, these are actually levied on the securities sold in the stock markets and the commodities sold in the commodities markets. So, based on the units that you purchase of a particular stock of a particular commodity such as oil, gold, or so on the stock exchanges, so you have to pay a tax according to the same. Finally, we had actually other kind of direct taxes. They are not now valid anymore in the country. We had the dividend distribution tax, which were actually levied on the dividends that the people used to receive from the stocks in the share markets. We also had this gift tax, where the individuals had to pay any kind of taxes on the basis of the gifts that they received from any other individual, right? And finally, we also had this estate tax, which is also not continued in India. So far, the direct taxes in India are only of the 4 types of taxes that we have seen here, right? Now, looking at the trends, see, recently we have seen that up to March 17, we had around rupees 18.9 trillion of taxes collection, right? And also we can see here, when we talk about the corporate income taxes, these income taxes have been increasing consistently over the last few months of the last year, right? So we can see that over a period of time, the country is seeing higher amount of tax collections. And also, if we understand, the more amount of tax collections is better for the government, because the government will be getting higher revenues, right? And when the government will be getting higher revenues, the government will be actually being able to spend the revenues on various social security schemes, right? and also it will be spending a lot on capital infrastructure in the country, right? Or that is also known as capital investment. So more revenues are actually better for the country, and that is what we have seen over the last few years. But there is one worrying trend. If we see, India is having almost around, say, 1,400 million people, right? But the main issue here, out of the total population in the country, only 5% are actually people who file their taxes on the income tax portal, or say they file for any taxes to be paid, right? So this is actually very low. This is something which we know as tax base, because these are the individuals who are supplying the taxes or giving the base of the taxes to the government. But we can see these individuals are very low at 5%, right? And these are the people who file their taxes. Finally, when it comes to paying their taxes, because you can just file that you have earned this kind of income, but maybe there are some individuals who do not even pay their taxes after filing. So you can see the actual number of people or Indians are only 1.5% of the Indians who actually pay their taxes, right? And majority of the taxes are actually paid by only 0.3% of Indians, right? We see that the tax base in the country is very, very low. So that is what the government must be doing some initiatives to increase the amount of direct tax collections. But we can see in recent time the government has taken many benefits, right, to actually increase the direct tax collections in the country. Now, here we can also see that the personal income tax is actually right now more higher than the corporate income tax, right? At around 28% of the overall tax revenues come from the personal income tax. Very, very important for your prelims. And also we can see only around 26% is coming from the corporate income taxes, right? Now, when we look at the comparison between indirect taxes and the direct taxes, we find that indirect taxes are higher at 65.8% than the direct taxes, which is at 34%. So we understand that indirect taxes like GST and customs are actually giving more revenues to the government than the direct taxes. But here we also can see much scope here, because we have seen that only around 1.5% of the Indians are actually paying taxes. So maybe if the government will be increasing the tax base of the country, the tax revenues will also be increasing over a period of time. So these were all the things that were important in this article, the very data in the same. And here I want all of you to solve this PYQ from 2021. According to recent RBI reports, it has been seen that there has been decline in the foreign exchange reserves of the country. Now, when we are talking about foreign exchange reserves, the foreign exchange reserves in the nation are actually composed of foreign currency assets, gold reserves, special drawing rights from the IMF, and also reserve transposition in the IMF, International Monetary Fund. So here recently, as we can see from the last year ended, the foreign exchange reserves has increased, but right now it is at around April 2024 data. As we can see, it is only at $640 million. So if you can see say months of February, March and April, the foreign exchange have actually been stagnated and even has decreased. The major cause of decline is actually to prevent the depreciation of the rupee. Now recently we have seen that rupee has been depreciating a lot, right? Rupee has been depreciating a lot, and when we talk about depreciation, we talk about rupee losing its value. And when something loses in value, when the supply of rupee actually increases, that means people do not want more rupee and they are actually dumping the rupee in the markets. And that is one of the reasons why the foreign exchange reserves have decreased. Why? Because to prevent depreciation, what the RBI can do, RBI can actually sell dollars in the market. Because when the RBI will be selling dollars, right, it will be again increasing the supply of dollars, right? And when the supply of dollars will increase, right, dollar will be depreciating, and when dollar depreciates, rupee will be also appreciating by a little bit. But over a period of time, we have seen that rupee has been depreciating, and RBI do not want excessive depreciation of the rupee. And that is why RBI actually is right now selling more dollars in the market to increase the supply of dollars, and hence strengthen the value of the rupee. So that is why in recent times the foreign exchange reserves are actually decreasing. And here, if we look more closely at the two important terms here, special drawing rights and reserve transposition in the IMF, we have to look at some of the important details. Now see, special drawing rights are actually a very special kind of, say, you can say a global currency that is actually supplied by the IMF. Now when we talk about the special drawing rights are actually accorded to the various members of the International Monetary Fund according to their quota in the IMF. So for example, imagine IMF to be a club, right? Now whenever India wants to become a member of the club, India has to make some donations or say kind of contributions for the club. So that contribution is actually quota. So according to the quota, the IMF will be in return giving India some club memberships, that is the SDR. So SDR is actually based across various currencies. So in SDR we have dollars, we have euro, we have yuan, we have pound, right? We have the Chinese renminbi, right? So here we have this amount of currencies in the SDR, and these are actually the main, say, club membership that India will be getting according to their quota, say, contributions. So SDR are actually allocated to IMF member countries in proportion to their relative share in the IMF, and countries can exchange the SDRs for hard currencies with other IMF members. Now, when we're talking about hard currencies, these are very stable currencies such as dollars. So the SDR by India can be exchanged for dollars with reference to the provisions of the IMF. And when are SDRs used? They are typically used during times of economic crisis, right? So here, for example, IMF distributed around 250 billion worth of say SDRs to its members, to all the members when the global financial crisis was actually taking place in 2009. So SDRs are actually used during crisis. Now, apart from SDRs in the reserve, we also have reserve transposition. Now, reserve transposition is also based on the membership quota of the IMF by the various countries. Now, here, during extreme financial emergencies, for example, this thing or this situation we have also seen in the case of Sri Lanka, right? So, for extreme conditions, the quota portion can be used by some countries. So for example, a country has contributed 100 rupees to IMF as a quota. So IMF has told in times of extreme crisis, 25% of the quota can be withdrawn from the IMF quota here for meeting any kind of emergencies. And here we have to understand that main definition of reserve transposition is actually the amount of member countries holding in the IMF that is readily available for withdrawal without any restriction from the IMF. So up to 25% of the quota they can withdraw without any permission, right? So the main benefits is actually immediate access to the funds during any balance of payment crisis. Even India had this balance of payment crisis in 1990s, right? And also this strengthens countries' foreign exchange reserves also, because we have seen that we can include the reserve transposition in our foreign exchange reserves in the RBI, right? And here we have seen typically the limit is around 25% of the IMS quota, and repayment is also expected within a short period, that is within 3 to 5 years. That means if you are withdrawing any money from the reserve transposition, you have to also give back the money back, and that money can be given back in 3 to 5 years, right? So here, according to the various IMF contributions and the various reserve transposition, the data will be published by the IMF, right, on the amount of reserve trans that various countries have on IMF website, correct? Now here, we have to see at a practice question for you all. In this question, you let me know what the answer is, right? In the comment section, you let me know what the particular answer is to this question. Recently, we received some data from the RBI on the outward foreign direct investment from India. Now, to understand outward foreign direct investment, we have to first understand what is the difference between FDI, that is foreign direct investment, and outward foreign direct investment, or OFDI. So the difference is very, very simple. When we talk about FDI, we have to talk about, say for example, India, and for example, say US. So for example, a particular US company or investor is interested to invest in India and set up a factory or set up a particular, say, shop or whatever, right? So whenever the particular investors from further foreign companies are coming to India and they are investing, for example, say in a factory, right, to produce more and more goods and services in the country itself. So that is actually known as foreign direct investment in the country, right? And when we talk about OFDI, this is just the opposite. When the Indian companies, the Indian individuals, they actually go abroad and invest in abroad assets, right? So this is the main difference, where FDI is an inward investment, OFDI is an outward investment. Now perspective, FDI, it has to be seen from India's perspective, because investment is actually coming from outward to India, and here this is from Indian companies' perspective, because Indian companies, they send their investments abroad, right? So this is the main difference here. And when we talk about the investor, it will be the foreign companies, the foreign net worth individuals who will be investing in India. And then when we talk about OFDI, it is actually Indian companies investing abroad, right? Now the main impact can also be seen. The main benefits of FDI is that it creates more amount of capital inflow. For example, whenever an investor from the US is coming to India and setting up factories, so it is firstly bringing, say, huge amount of foreign currencies such as dollars in the country. It is also, giving high amount of employment opportunities, because to operate factories, to operate any new entity, you need more and more labor force. So this labor force actually will be supplied by the Indians itself. So Indians will be getting more job creation will be happening. So foreign companies, they can, apart from bringing currencies, they can also bring their modern technologies. So new technology will be also coming, right? Technology transfer will be happening, where the Indian companies, they can also learn from the technologies. And also infrastructure will be improved over a period of time, because to attract more and more FDIs from the foreign nations, the government will be actually building better roads, better ports, better airports, and so on. And when we talk about OFDI, this is from the perspective of Indian companies. So for example, any Indian company like Adani, Jio, and so on, they would want to diversify their markets. They would want to improve their access to new resources, that is in abroad nations, right? And they would want to have more returns on their investment and also increase their brand recognition. So these are one of the main important benefits of having more OFDI from the from our country. Now here we have to look at the data, recent data from the Reserve Bank of India. See, if you look at 2022 and 2023 in millions of dollars, if you can see, in 2022 the OFDI, right, or outward FDI from India, they were actually more higher in the 2022. But in recent times, as we can see, this has decreased. So in recent times, OFDI has decreased, right? And also if you can see, the preferred sources of investment by Indian companies abroad is actually in various nations. Now please do remember, say for example, the highest amount of investment from India to abroad is actually going to Singapore, followed by US, followed by UK, Netherlands, and UAE. So please do remember the top five OFDI destinations for Indian companies. These are the main important aspects for your prelims. So these are the things which UPSC can be asking regarding the various data. Say for example, it can ask you that in 2023 the OFDI trend has increased comparison with the last year, so it would be wrong. And also it can ask you about highest destination of the outward FDI from India. So please be aware of this small amount of data. Now recently we saw a new appointment at the Securities Appellate Tribunal. Now the name of the officer and the name of the member is not that much of importance for UPSC. We have to look at what this Appellate Tribunal is actually functioning for. Now when we talk about Securities Appellate Tribunal, this is a statutory body under the SEBI Act 1992. So obviously it will be looking into all the appeal cases, with reference to any disputes taking place with reference to the offences outlined in the SEBI Act, from the IRDAI, PFRDA, and so on. So whatever you, me, or any other individuals will be having issues from SEBI, say registered companies, stockbrokers, and so on, right? Insurance companies and so on, or say provident fund issues and so on. So these kind of issues will be addressed by this Securities Appellate Tribunal by hearing the appeals, right? And the jurisdiction is actually pan-India, so the all of India will be actually covered under the jurisdiction of SAT, and here the members will be consisting of one presiding officer who shall be a retired judge, and also 2 other members, and all of the members here will be appointed by the committee headed by the Prime Minister of the country. So these are all the things that you need to know with reference to SAT. Recently, India extended the peace clause for the 5th consecutive time. That is a significant provision of the WTO for the developing nations. Now let us understand these very complex topics with reference to very simple examples. Now, when we talk about the World Trade Organization, this was actually set up under the General Agreement of Trade and Tariff, right, which was conceptualized in 1995 under the Uruguay rounds of negotiation. Now, the main principles of WTO can be summarized in 4 main aspects. Firstly, WTO seeks to give the principles of non-discrimination, that is firstly most favored nation status and the national treatment. Apart from it, it also prohibits the use of any quantitative restrictions on trade, and also any giving any tariff concessions, and also specific commitment. Now let us understand all of the principles using very simple examples. Now imagine that India intends to import coffee from 2 major coffee exporters. So we know that Brazil and Vietnam are actually 2 major coffee exporters all across the globe. So India seeks to import the same. Now here, for example, India has its own domestic coffee producers. For example, in states like Kerala, in states like Karnataka and so on, we also have coffee producing states. So if we unlimitedly try to say import coffees from the rest of the nations, the domestic workers, the domestic coffee manufacturers, coffee farmers, they will be at hurt. So that is why maybe India will be telling, okay, we will be importing a portion of coffee from Brazil and Vietnam, but maybe we'll be imposing, for example, a 10% tariff. Right? So what happens on a usual day? Brazil and Vietnam is actually exporting coffee to India. Now India can tell that, okay, Vietnam is actually my very close friend. So what I can do, instead of applying 10% tariff from Brazil or say Vietnam, I am only imposing 5% tariff to Vietnam itself, because India and Vietnam are very close partners, right? So it can happen that maybe India will be giving some special treatment to Vietnam. But if you are a member, or say if India is a member of the WTO has told that you cannot discriminate between your trade partners, because the coffee makers in Brazil, they will be thinking that, okay, you two are great friends, so we are at a loss, then we will also impose some tariffs on you. Then this will be creating a trade war between the nations. So that is why the WTO has told that economic peace must be there. So that is why if India is levying 10% tariff or say duties on the import of coffee into the country to protect the domestic manufacturers of coffee, it has to impose the same to Vietnam also, to Brazil also. So both must be paying 10% of coffee or say import duties and any kind of tariffs with reference to Indian authorities, right? So this is the most favored nation status of the WTO. WTO believes that if economic trade and relations must be proper, all of the nations must be given most favored nation status, right? So here for India, right, you cannot have you cannot favor Vietnam more, or you cannot favor Brazil more. If you are having trade relations, you have to have a proper trade relation with both of them. Then national treatment. When we import the coffee into Indian markets, and for example, there is a shopkeeper which is selling both the domestic coffee and the Brazilian coffee. So at the domestic markets, you cannot promote the Indian coffee or say Vietnam coffee or say the Brazilian coffee more or less. If once a foreign good has entered your market for sale in India. So all of the items must be given national treatment, or say, right, you cannot discriminate that this is a Brazilian coffee, right, this is a Vietnam coffee, and this is the Indian coffee, right, these have very different features and so on, right. So you cannot do the same in the conditions here. So all of the goods and services which will be sold in India, which are exported from the other countries and also which have been imported from the different nations and also produced in the country, they have to be sold equally without any discrimination. Next, another significant core principle of WTO is actually prohibition of quantitative restriction. That is we have assumed that in the beginning time there is a, for example, 10% of tariffs, right. Now WTO is telling that there should be a prohibition of the quantitative restrictions. That means there cannot be any, say, restriction on, say, the amount of, say, the coffee that can be imported or, say, exported and so on. So any kind of amount or, say, unit or quantity restrictions must not be there. Next, tariff concessions must be given. For example, say if the tariff initially was 10%, maybe over a period of time, right, that particular tariff can be reduced to 5%, can be reduced to 4%, because if you reduce the tariffs, it will be better for the consumers of the market, because higher tariffs will be making the prices of the coffee more expensive, right. So you have to understand that over a period of time, the amount of, say, tariffs, they must be reduced, right. So this is the main aspect of tariff concessions, because we have to understand under most favored nations, once you are imposing one tariff to another nation, you have to also impose the same to all of the nations under, or all of the members of the WTO. Then under, say, these specific commitments and so on, so you have to make a commitment that over a period of time, you will be reducing the tariffs to make economic trade and exchange more easy and more affordable for the end consumers. Now, we understand that in a developing country like India, right, the government can give many subsidies to people, like, for example, farmers, where farmers get minimum support price known as MSP, and also the poorer sections of the population, they get benefits under the public distribution system, or say the ration system, right, where highly subsidized food grains are actually given to the poorer sections of the population because of food security imperatives of the country. And also farmers need a particular remuneration for their crops, right. Now here, this MSP support and the PDS support, right, they actually go against the principles of the WTO, be it the most favored nations or any of the four principles that we have discussed right now. Because what, according to WTO and according to various other developed nations, what they say, that because the government is giving high amount of support to the farmers under MSP. Now if the government is giving support to the farmers, for example, because the people who are actually growing our crops, so if we give more and more subsidies to the farmers will be seeing lower cost of production, right. Now according to WTO principles, lower cost of productions is not fair in international trade, because if the farmers are having lower cost of production, the farmers will be producing more, right. If farmers are producing more can be produced at cheaper prices, right. And maybe there would be some countries, abroad, who are not giving this much of support to the farmers, and that is why their own rice or wheat and so on, agricultural products, they are priced higher in comparison with the Indian farmers and so on. So that is why we find that maybe this MSP is causing a discrimination across the international trade with reference to the various goods and services from the farming sector, right. But the main aspect we have to understand, we are giving MSP because the farmers, most of the Indian farmers, or say 86% of the Indian farmers in India are actually small and marginal farmers who have less than 2 hectares of land. And they're actually farmers who actually have very less amount of produce, and they're also having many issues at their end. Then also we understand whatever the government is procuring, say rice or wheat under MSP, they're distributing most of the goods and agricultural goods to the public distribution system for the poorer sections of the population. So it is not a kind of a, say, trade promoting aspect of Indian agriculture subsidies, right. It is because the farmers of the country, they need the particular income, and also the poorer sections of the population, they need food to live. So that is why India, according to India, the WTO provisions are actually not justified when we talk about the say inclusive growth that the country is actually promoting. So that is why in say the international trade aspects and also the WTO trade negotiations, these Indian farm subsidies and the PDA subsidies has come to say dissonance with the WTO core principles, and that is why the WTO also came up with an agreement on agriculture. So we have this agreement of agriculture right now with actually 3 pillars. Firstly, we have market access, domestic support, and export competition. Now, under market access, under this agreement on agriculture, it has been told that the tariffs, whatever the tariffs that India is having on agricultural import from other countries, right, they have to be reduced over a period of time, right? And also with reference to the tariff rate quotas or say the quantity restrictions, they also have to be reduced, and also there has to be some special safeguards, right, for the Indian agricultural produce. So going into the detail is not that much of important. We have to understand that firstly, under agreement on agriculture, India has to improve the market access of foreign agricultural produce in the country over a period of time. Or we have to not only talk this in context of India, but also in context of various other developing nations also. Developing nations such as Brazil, say Latin America, African nations, Southeast Asian nations, they are also developing. They also have the support to their farmers and their say food security imperatives for the poorer sections of the population. So that is why they also have given a lot of subsidies to those sections of the population. And that is where these developed countries and the developing nations are coming to force at these WTO negotiations. For this, we have this first market access. Next, we have this domestic support, where the domestic support has been arranged into 3 boxes. By domestic support, I mean the government subsidies that the government is actually giving to the agricultural sector. Now this has been categorized in 3 boxes. Firstly, the green boxes. So whatever the government is spending on agricultural research, innovation, and so on. So those kind of expenditure by the government of India and other developing nations is actually clubbed under green box, because this expenditure on agricultural research, better quality of fertilizer, seeds, the research and aspects and so on, right? So they do not cause any trade distortion between the nations, because this is a kind of a expenditure the government is doing to promote the growth of, or say the growth of and productivity of the crops in the nation. So these are not distorting any kind of trade here. Next, we have this blue box subsidies, which are a broad range of subsidies that are allowed, but they actually are given to the farmers to minimize their production, or say to reduce their production, or say farm produce. So according to WTO, these green box and blue box subsidies that are given to farmers, they are allowed, but there are some subsidies which are known as amber box subsidies, which must be reduced over a period of time, because amber box subsidies are the subsidies which are given on farm inputs. Farm inputs such as, for example, the MSP provision that we have seen, right? Or say the fertilizer subsidy, right? Or say the seed subsidy, which the farmer give, which actually the government gives to the farmers to purchase the farm requirements. So when the government is giving these kind of subsidies, for example, to the farmers, it is reducing their cost of production, and this is why maybe the farmers will be producing more and more crops, and if they are producing more and more crops in India, maybe they will be exporting the same at a cheaper price to the rest of the nations, and these cheaper prices will be leading to losses of the foreign farmers and so on. So that is why these subsidies, according to WTO, has been kept in the amber box, and they must not be more than 10% of the overall agricultural crop value of a particular year. For developing nations, and for developed nations it is 5. So for developing nations, the amount of subsidies that they can give maximum, right, should be at 10% de minimis provision. So this is the de minimis provision, where up to 10% the government can give the subsidies, but more than that they are actually known as prohibitive subsidies. That means these subsidies must be stopped. Now you can understand obviously India would not be agreeing to this amber box provision, and that is what we see. This is the main reason of the origin of the peace clause, right? So in Bali conference of the WTO, India and other developing countries, they went to the WTO and they told the WTO that this 10% is way too less, because our farmers, our poorer sections of the population, they need more than 10% of the subsidies. They need more than 10% of the overall produce of the agricultural, produce in a particular year. Because if we do not produce that, if we do not give the farmers this kind of subsidy, we will not be able to fulfill our own food security measures. So that is why the WTO and the developed nations, they also agreed to this demand. They told that, okay, for a temporary period of 5 years, you can give, for example, say from 2013, when this peace clause actually was brought into, when the negotiations were actually started and formalized, right? The developed nations and also the WTO told that there should be a peace clause where you can exceed this de minimis provision, that this 10% provision, the developing countries then that they can exceed this kind of provision here under the peace clause negotiations, and that is the provision that we have under WTO right now. So that is known as the peace clause here. And apart from this, we also have various the third pillar of export competition, where the export subsidies and the anti-circumvention food aid and all of the other things, they should be also reduced. But the most important pillar here is actually the domestic support here, as we have seen here, right? Now here, as we can see, right, this is the de minimis 10%, right, which is actually a provision of the amber box subsidies, and we know that the amber box subsidies, according to the WTO, they have to be reduced. But after this, we have seen the developing countries, they went to the WTO and they told that this is not possible. In real life, as you can see from this particular data, in real life, the government give more than 10% support to the farmers to actually increase the crop production for food security imperatives, for farmer support and so on. So that is why in real life, India gives 11% support, 13% support, 15 and 12% support even in recent times. So if you can see, over the last 5 years, consecutively, India has given more than 10% support to the farmers, right? 10% support to the farmers as agricultural subsidies. So India has consecutively has breached this particular limit here, and that is what is very, very important for us to understand, because especially if you consider 2020, 21 and 2021-22, these were the COVID pandemic years, and in this particular year, the government actually had to give more support to the farmers, more support to the poorer sections of the population. Otherwise, they would be not having this amount of public welfare. So that is why India needs this support more than the 10% de minimis provision. Now here, this has been extended for 5th consecutive time, and India's argument is actually for public stockholding, or to maintain lot amount of buffer stocks for the nation, because we have to understand, we have to distribute the same under public distribution system to the poorer sections of the population. And when we're talking about the public distribution system, we're talking about the National Food Security Act, where 75% of the rural population are covered and 50% of the urban population are covered for subsidized food grains to the population. So to maintain this amount of stocks, we need higher amount of agricultural produce. This is not India's aspirations to export cheaper agricultural produce. This is the first aspect of public stockholding. Next, India also argues that the prices for which this peace clause and also the de minimis has been agreed upon is actually outdated. That means this is actually based on 1986 or 88 prices. And also, India wants a permanent solution to this particular peace clause, because peace clause is a temporary solution. For when it was agreed in 2013 Bali Ministerial Summit of the WTO, it was agreed for initial of 5 years, but right now it has been extended even more. So India also wants a permanent solution to this particular issue. Now here we have two PYQs from 2015 and 2016. So please do attempt this in the comment section and let me know what is the right answer here. Recently, the government of India launched two new UPI features. The very first feature is the cash deposit machine using UPI system. For example, you have seen across, right, many cash deposit machine where you just take your cash and you deposit the same using your card details, right? But here right now you can do the same thing with your UPI. That is, you go to this cash deposit machines, you take a scanner, you open the scanner in your mobile phone according to your bank application, and you do the same. You enter the amount of money that you want to transfer using cash, and the same will be facilitated via UPI. Now, this particular facility is actually only possible at cash deposit machines, which are actually ATMs that allow customers to deposit cash directly in their bank accounts. They are a convenient way to deposit cash during branch hours, right? And also, we can understand if you deposit the same without say going to a branch, this is actually more convenient for you because cash deposit machine work 24/7, right? And also, unlike ATMs which only dispense cash, the cash deposit machines can both dispense cash and also can accept cash deposits. So this is a very, very good feature for the UPI users who can withdraw and or say the cash and also deposit cash without even using their debit or credit cards. Now, the next feature is actually enabling UPI payments from the PPI or prepaid payments instruments. Now, you have all heard about these wallets of various say companies, right? Say MobiKwik, PayUmoney, Citrus, Amazon Pay wallet, and various other wallets, right? Now, it is possible for you right now to actually transfer, for example, say money using UPI from Amazon Pay wallet to any other wallet, for example, say PhonePe wallet and so on, right? Now, at present, UPI payments from PPIs can only be made using the web or mobile app issued by the PPI user, right? But right now, the new feature will be permitting the use of third-party UPI apps for making UPI payments from PPI wallets. That means you can use any kind of applications or any other third parties to send and directly transfer your money using UPI. So this is a very, very good amount of initiative that will be leading to financial inclusion in the country. Recently, a very interesting topic known as paradox of thrift appeared in the Hindu, and we have also look into this concept more clearly. Now here, paradox of thrift can be illustrated using this simple cartoon. See, on this one hand, this cartoon is telling, right, to save, because obviously we understand if we have higher amount of savings right now, we can have a better quality of life in the future. But on the other hand, the private companies are telling you, spend, do not be selfish, do not do this to the economy, because if you do not spend right now and if you save more, then the private companies, what they will be doing with their smartphones, cars and so on, right? They will not be able to sell anything and they will be staring at losses. And maybe you also work at a car manufacturing company, and maybe if you are saving more, you are not buying many cars and other individuals are not buying many cars, you will be out of a job, because if more of the people are actually saving right now, they will be say not employed by the say private companies, because the private companies, they will be seeing that people in the nation are not spending anything, so why will I produce more? So let me fire individuals here, let me fire my workers. So that is the main aspect of paradox of thrift. That means savings on one side is good, but on the other side it is bad for the capitalistic economy, because we have to understand capitalistic economy is actually dependent more on the spendings of the individuals, because the more they spend, the more the demand for the goods and services will be rising. And whenever the demands of goods and services will be rising, we know when more demand rises, prices always rise. And when more prices rise, the farms and the producers, they will be trying to even produce more, and the production will be increased, and also when the production of the economy will be increasing, the jobs in the country, they will be also increasing. According with the same, the GDP of the country, that will be also increasing. So if we understand, if the people spend more, the demand increases, the price increases, the production increases, this creates more job and employment, which increases the GDP of a country. Now this is actually a Keynesian theory which was proposed by John Maynard Keynes, who is known as the father of modern economics. And when we talk about this liquidity or say this paradox of thrift, we mean that people should not be saving more, right? Because they need to be spending more to increase their GDP, because we know higher amount of GDP is always better for the nation, right? And this is also one of the ways in which we can also understand business cycle. Now for example, imagine any company, for example say imagine a textile company, right? We understand that in India we have many festivals, and during festivals want to agree that demand for textiles, they increase. For example, during puja vacations, during Diwalis and so on, the demand for textiles, they will be increasing, right? For example, say even electronic companies such as TV, smartphones and so on, they also see their increased demand during festivities. So business in any economy actually operates via cycle. So for example, demand will be higher during festivities, demand will be lower during normal times. So this is how simple business operates. But if people are in the economy saving more, then who will be demanding more? The business cycle, they will be collapsing, right? And when we are talking about business cycle, we are talking about a calendar year, when there are some months when the businesses will be seeing more demand, such as the festivities, and there are some months where the business will be seeing normal demand. And also, when they will be seeing more demand during festival issues and so on, right? Then the companies will also be employing more, and more employment, we have seen, it is better for the economy. But paradox of thrift is actually disrupting that that kind of business cycle, because if the people are actually saving more, right, they would not be spending more, right? And this is also one of the things which also describe the recessions during economy. Now recessions is the part of the economy where for consecutive 2 quarters of the economy, right, the GDP falls, the GDP growth falls. Now why the GDP growth falls? Because during recessions people lose their jobs and they have to actually save more, right? That is one of the reasons why recessions may even occur, because maybe people are actually saving more and they're not spending, and that is why the GDP is also decreasing. And this is one of the cases where paradox of thrift is actually seen in real life. And here we need to look at some of the criticisms of this theory too. Now paradox of thrift is actually leading to more and more pools of saving. That is, paradox of thrift tells that people should be saving more because their future generations can actually, or their future demands can be met. But when they're saving more, they're actually saving more in the banks. And obviously, when they are saving more in the banks, investors, particularly the entrepreneurs, right, they will be demanding more money as loans from the banks, and the banks are having higher amount of savings with themselves, so they can even give the same at lower interest rates. Want to agree that the banks will be giving the same at lower interest rates, and when we are having lower interest rates, the investors will be demanding more and more loans. So from an investor point of view or entrepreneurial point of view, this will be leading to more and more investments in the economy, and this will be also leading to time aspect of saving. That means if a particular individual, for example, in his 20 years, right, 20 years of age, he is saving for say retirement at, for example, say 50 years. So when the particular individual will be spending in 50 years, this is actually giving a signal to the investor to actually create companies that will be catering to the demands of the people 30 years from now. So the companies can actually allocate their resources accordingly from now only to actually create economies that will be present in the future. So it will be also leading to better planning of the economy, because obviously if a particular is saving some money under paradox of thrift, they would not be saving forever. They will be spending the money somewhere that will be in the future when the investors will be creating such companies in the future, right? such as more and more hospitals, so more and more say old age institutions that people will be requiring in 50 years when they attain their 50 years of age. So investors will be allocating their or say changing their business operations in the same manner. So this is the main aspect of this particular principle. And here recently we got some data regarding REER and NEER with reference to the exchange rates in the economy. Now to understand REER and NEER, first we need to understand what is exchange rate of an economy. When we talk about exchange rate, it is just a simple division of one currency divided by the other. In normal times when we talk about the exchange rate, we talk about a foreign currency such as dollar divided by the rupee. So this is the normal exchange rate which we see in the international arena and also in the international debates. Now we see that this is the normal formula of exchange rate. Now exchange rate with reference to any country or a currency, for example rupee, can appreciate or depreciate with reference to the exchange rate. Now when we talk about appreciation of the Indian rupee, that means that rupee's value is actually improving. That means, for example, say earlier we had 80 rupees to $1. When the currency is appreciating, that means Indian rupee is actually gaining in value. That means Indian rupee, for example, is now 70 rupees. Now if 80 rupees became 70 rupees right now, or say the denominator decreased, right? Now we know when the denominator will be decreasing, the exchange rate will be increasing. So whenever we have appreciation, we see exchange rate to increase. Whenever we have depreciation, or say now we have 90 rupees to $1, we understand that the denominator will be increasing and this will be leading to decrease in exchange rate. So depreciation means decrease in exchange rate. Simply always remember this simple fact. Firstly, that exchange rate in normal say comparison in normal economic studies, it means dollar is to rupee, and whenever rupee appreciates, exchange rate increases. When rupee depreciates, exchange rate reduces. So this is the normal exchange rate formula that you have to keep in mind. And this is the same formula, this is the same principle that will be applying in REER and NEER too. And now when we talk about REER and NEER, we have one term in common, that is the effective exchange rate. Now this exchange rate we have seen is actually comparing only rupees and dollars. This is actually only two currencies. But in real life, do India only trade with US? No, because India also trades with China, Europe, UK and various other nations. So effective exchange rate considers not only dollars, but also pounds, but also various other currencies, right? So here effective exchange rate is the index of weighted average or simply the average of the rupees exchange rate with reference to the currencies of India's major trading partners. So for example, India trades with around say 40 countries around the world. So our net total of average of all the currencies with whom India trades will be calculated in effective exchange rate. So it can be simply imagined that all the other currencies is to be divided by rupee. This is actually what we mean by effective exchange rate, and these are the currencies with whom India have a maximum amount of trade volume. Now here there are two measures of effective exchange rate, NEER and REER. Now here let us understand the differences between the two. See, when we talk about nominal exchange rate, it is just the effective exchange rate that we have seen right now. See, it focuses on nominal exchange rate. The calculation is a weighted average of exchange rate of India's major trading partner. That is, we are not only calculating dollars value with Indian rupee, we are actually calculating all the other currencies with whom India trades. Now, in NEER, inflation is not considered. Whatever the market rate is, it is considered that only, right? But here when we consider NEER, it is very simple to understand. It is just NEER. It is just NEER minus inflation, right? So NEER is adjusted for inflation, both domestic and foreign trading partners inflation, the inflation effect on their currencies, and that value is known as REER or real effective exchange rate. Always remember that whenever we find the term real, right? It is always kind of adjusted for inflation in major economic terms, in not all economic terms, but in major economic terms, right? So NEER is REER minus inflation. Now the implication, the interpretation is that here, that higher NEER, that means higher effective exchange rate, or say nominal effective exchange rate, is actually, as we have seen in the previous one also, if we see, if exchange rate increases, that means rupee has appreciated. That means higher NEER indicates stronger rupee, that is appreciation. Lower REER indicates a weaker say rupee. That means the concepts of exchange rates, the increase or decrease of exchange rate is the same in both NEER and REER, right? Because the formula is same. That is, we're calculating all other currencies divided by Indian rupee. So this is the normal, effective exchange rate, the nominal exchange rate, right? Also the same is the same for real exchange rate, but the main difference here is that it is adjusted for inflation, right? And also we have to understand, REER is actually referring to the purchasing power of the currency. But here in NEER, it is actually the nominal exchange rate, because when we minus inflation from NEER, that means it is actually the main say real value of the currency to buy any other currencies. So because we are just adjusting inflation within the same. Now here, if we look at the recent data here, right, according to Indian statistics, we take the base year for NEER for 2015-16, and also for the REER base year we have taken as 2015-16. As we can see here, in the latest years, right, we find that the NEER right now is actually 90, right? The NEER right now is 90, and as we can see, the REER is actually at 101. That means we see that we have more value of REER than NEER, because simply this is adjusted for inflation in across both Indian rupee inflation and also the other trading partners inflation. So that is why the value is actually low for the NEER. And here we have a PYQ from 2022 for all of you to solve in the comment section and let me know what the answer is all about. So this was all for the recitals for the month of April. I hope you enjoyed a lot. Please do let me know of all the answers that we have shown for the questions here in the comment section. And always we will be wishing all the best for all your exams ahead. All the best of luck, and till we meet again, thank you.